The United States has seen its share of catastrophic economic disasters, each leaving behind lessons and scars. From the Great Depression to the 2008 financial meltdown, these events shaped industries, policies, and millions of lives. Join us as we uncover the 10 worst economic disasters in American history and the profound impact they had on our nation. Number 1. The Panic of 1837. The Panic of 1837 was triggered by speculative land investments and poor banking practices. When President Andrew Jackson eliminated the Second Bank of the United States and issued the Specie Circular, requiring payments for government land in gold or silver, it caused widespread panic. Banks ran out of hard currency, and credit collapsed. Over 40% of banks shut down, unemployment soared, and businesses failed. Farmers lost their land, and families faced severe poverty. Recovery took nearly 7 years. This disaster underscored the dangers of speculative bubbles and weak financial oversight, setting an early precedent for the importance of regulation. Number 2. The Long Depression, 1873 to 1879. The Long Depression began with the collapse of Cooke and Company, a prominent investment bank heavily involved in financing railroads. This failure led to a stock market crash and widespread panic. Over 100 railroad companies and 18,000 businesses went bankrupt, and unemployment reached 14%. Workers faced wage cuts and strikes, with many families descending into poverty. The Depression highlighted the dangers of over-reliance on a single industry like railroads. It also showed the need for economic diversification and better financial management, as the recovery process required significant changes to banking and industrial practices. Number 3. The Panic of 1893. The Panic of 1893 was fueled by railroad overbuilding, shaky investments, and declining gold reserves. When major railroads and banks collapsed, it triggered a deep economic depression. Over 15,000 companies and 500 banks failed, leading to unemployment rates exceeding 20%. Cities saw an explosion of homelessness, and soup kitchens became common. Labor strikes, like the Pullman Strike, marked the social unrest of the time. The crisis revealed the instability of the U.S. financial system and its overdependence on speculative industries. The government eventually intervened by increasing gold reserves, stabilizing the economy after several years of hardship. Number 4. The Great Depression, 1929 to 1939. The Great Depression began with the infamous stock market crash of October 1929, wiping out billions in wealth overnight. Banks failed as panicked customers withdrew their savings, leading to a collapse of the financial system. Unemployment soared to 25%, and millions of families lost homes and businesses. Breadlines and shantytowns, nicknamed Hoovervilles, became common. President Franklin D. Roosevelt's New Deal introduced programs like Social Security and public works projects to jumpstart recovery. Though it took a decade and World War II to fully recover, the Great Depression reshaped economic policies and social safety nets for future generations. Number 5. The Recession of 1958. The 1958 recession, though short, marked a significant economic downturn during a time of post-World War II prosperity. A decline in industrial production and a slump in consumer demand led to rising unemployment, peaking at 7.5%. Automobiles and housing markets were particularly affected, as layoffs spread across major industries. Despite its brevity, the recession exposed vulnerabilities in the economy's heavy reliance on manufacturing. The government responded with tax cuts and public spending to reignite growth. This period taught the importance of economic diversification and highlighted the need for proactive fiscal policies to prevent deeper recessions. Number 6. The Oil Crisis and Recession, 1973 to 1975. The 1973 oil embargo by OPEC nations created an energy crisis that brought the U.S. economy to its knees. Oil prices quadrupled, leading to gas shortages, long lines at pumps, and rationing. Inflation surged, unemployment rose, and the economy stagnated in a phenomenon called stagflation. Americans faced skyrocketing prices for basic goods and declining purchasing power. The crisis exposed the nation's dependency on foreign oil, prompting initiatives to explore alternative energy sources and improve energy efficiency. It also forced policymakers to rethink economic strategies, as traditional tools were ineffective against simultaneous inflation and unemployment. Number 7. The savings and loan crisis. During the 1980s, deregulation allowed savings and loan institutions to take on high-risk investments. When these investments failed, over 1,000 institutions collapsed, costing taxpayers $124 billion in bailout funds. Millions of Americans lost their savings, homes, and trust in the financial system. Entire communities suffered as local banks disappeared. This crisis highlighted the consequences of inadequate oversight and risky lending practices. It led to stricter regulations, such as the Financial Institutions Reform, Recovery and Enforcement Act of 1989, aiming to restore stability and prevent future banking collapses. The lessons from this era remain critical for modern finance. Number 8. The dot-com bubble burst, 2000. The late 1990s saw a frenzy of investment in internet startups, many of which had little to no revenue. Stock prices soared, fueled by speculation rather than solid business fundamentals. By 2000, the bubble burst, wiping out trillions in market value. Companies like Pets.com and Webvan went bankrupt, and tech workers faced massive layoffs. The Nasdaq index lost nearly 78% of its value by 2002. Number 9. The Great Recession, 2008 to 2009. The 2008 financial crisis began with the collapse of the U.S. housing market. Banks issued risky subprime mortgages, which defaulted in large numbers. Major financial institutions like Lehman Brothers went bankrupt, sparking a global economic downturn. Unemployment reached 10%, and millions of Americans lost their homes. The government intervened with a $700 billion bailout and stricter financial regulations, including the Dodd-Frank Act. The crisis had long-lasting effects on the global economy and personal finances. Number 10. The COVID-19 recession, 2020. The COVID-19 pandemic caused an economic collapse like no other. Businesses closed due to lockdowns, supply chains broke down, and unemployment skyrocketed to 14.7%, the highest since the Great Depression. Entire industries, such as travel and hospitality, came to a standstill. The U.S. government responded with massive stimulus packages, including direct payments to citizens and support for small businesses. While the economy began recovering in 2021, lingering effects persisted, particularly in labor markets and inflation. This crisis highlighted the vulnerabilities of a globalized economy and the importance of public health in maintaining economic stability. Economic disasters are more than just numbers and percentages. They're stories of resilience, recovery, and reform. Each crisis brought hardships, but also valuable lessons that shape the policies and practices we rely on today. If you found this journey through history enlightening, don't forget to like, share, and subscribe for more captivating content. See you in the next video.